Do you guys in the audience think that trading is fair? Can I ask you that question? How many people think it might not be fair? So, wow. Put your hands up again. That's like almost everybody.
How about a follow-up to that question?
Yeah,
For the people that have their hands up, do you trade yourselves or do you invest in mutual funds and your mutual fund trades for you? Maybe, I guess, the first group. How many of you that raised your hands trade for yourself, buy and sell stocks regularly?
Yeah, a couple. Do you think their concerns are unwarranted?
No, I think it's valid. I mean, I think, people, you don't want to go, to a casino if you think it's fixed, right? And by the way, a casino is fixed against you, right? But, you give them $1, you get 70 cents back as many times as you want to play, right? It's better than Lotto, though. You give you $1 and you get 50 cents back, right? The bumper sticker is Lotto for people who are bad at math. But
when the argument has gotten to the point that there has been such a visceral reaction to a delay of 350 millionths of a second in the market, most people they can't comprehend that, and that seems to imply that there's some level of unfairness. If you have to worry about 350 millionths of a second, then how can that market be fair?
I mean, I do a little bit of both. I'll do institutional trading and personal trading. And for institutional trading, it's pretty quick, it's pretty fair. You know what the game is, you know what you're trying to accomplish, you can do it. And, sometimes it goes for you, sometimes it goes against you. But when you see a stock offered at a half and you go to buy it, you'll buy it at a half. Now, you may not buy as much as you want to buy, but it's pretty fair, spot to spot. And for trading personal account type trades, you're buying 500 shares of a stock, 100 shares of a stock, maybe 1,000 shares of a stock. This is an investment for a long time. You're going to own Home Depot or IBM for a long period of time. You go into the marketplace and give your broker an order, you're going to get done pretty quickly. It's as fast now, if you go through your Schwab account or whatever it might be, you can, there's pretty good disclosure as far as where the price is offered or bid if you want to buy or sell, and it's pretty quick and you're done. If anybody's buying or selling a house, the real estate market isn't that way. I mean, it's incredibly cumbersome to get, between bidding wars and all that. So stock trading, it's pretty transparent, and you can get done what you need to get done. The trickier part is the in-between type trade where you might have 50,000 shares to buy. Again, for those of you that are in mutual funds, your mutual fund trader on your behalf is trying to buy or sell a stock, and there might be 10,000 shares offered, and this might be too granular, but you buy that first 10 really well, but the next 40 cost you $0.50. And that's the kind of thing where an IEX and sort of a fairness type system may smooth out the marketplace such that it doesn't disrupt and set off these algorithms against you to try to buy the balance of your order, right? So that's the part that's trickier, and then you just have to decide about how patient you want to be on executing the balance of your order depending upon your time frame. And there's a lot of traders get paid a lot of money to try to figure out how to navigate that matrix, if you will. But that's the part, the in-between part, where I think it's the market becomes a little trickier. Small trades and really big trades, you seem to be able to get done pretty well.
From an academic perspective, I don't think the markets have ever been more efficient or fairer as they are today, and that's down a lot to the fact that trading is done at a very fast rate these days.
You think they're?
Yes, I think they're a lot fairer. Looking at the data, and I've examined over 100 billion quotes and transactions from 4 major exchanges in Europe, so I do know based on that evidence that that's the case, and that's all down to the increase in liquidity, the fact that a lot of information is incorporated into prices at a very fast rate. So when you are buying your stocks, you are quite confident that you are buying on the basis of the latest information. Having said that, it doesn't mean that the market is still completely fair. It's just that it's a different set of guys these days that are making it less fair, and they are not making it as unfair as it was before when the market was fully in the hands of the specialists or the broker dealers. And so I think it's just a new class of guys who are responsible for the unfairness in the market, but the level of unfairness has reduced tremendously. Transparency has increased in the market, especially with increased market fragmentation, as long as it's not too excessive.
Well, your data might be very, very important for this discussion, particularly I don't know how it would apply to America, but I will tell you as a reporter, I was a runner on Wall Street back in the 1970s when there were fixed commissions. And then it was very, very expensive to make a trade. And so they eliminated fixed commissions, and there was a general assumption that every year the cost of a transaction was dropping. And I would say that continued through much of my career. But then I went off to Asia, and I came back to America to be a reporter again. And I wanted to get data on whether stock trading is more efficient, because after all these computers and all this electrification, I thought it should be. And all of a sudden people said, yeah, it's more efficient than it's ever been before. But you'd ask, and again, it was America, not Europe, you'd ask for data and they go, well, it really doesn't necessarily show that. So then I spoke to the SEC and they said, because they're supposed to look at this because they're making all the rules. And they said, yeah, we have data on this, but we don't release it to the public. So I'm like, wait a second, you don't release data on transparency to the public, so it's not transparent to the people who use it. I was just absolutely befuddled, and I felt that whether it has actually become more efficient in the past, let's say 5 years, I'm just picking a number of 5 years or so, I really don't know. And in fact, most of the people I talk to really don't know. And it's very, very, you talked about, in a sense, I guess one description would be slippage. You get your first trade at a certain price, but your next trade is at another price and another price and another price. So you might think that your first trade is very, very efficient for a share, but actually by the time you complete your trade, it can be very, very expensive. The market moves away from you, and worse than the market moving away from you, it moves away from you because you are trading. You become the catalyst to get yourself a lousy price. And I think people really, maybe your data on Europe is great. I don't think this has been done in America. I just have not seen good research recently on this. A lot of people feel that even if you see a single trade go in a millionth of a second and it looks very, very efficient, actually the pricing efficiency is it's gotten worse, and it's gotten more deceptive, and it's gotten more disturbing. But you had something you wanted to say.
No, I was just going to give an example of why faster trading times could actually bring about more efficiency. On an average day in financial markets, on the NIS, for example, you're going to have the market maker struggle to provide liquidity due to inventory pressures. When this happens, the security that is being traded would deviate from the underlying value that it has. So a couple of decades ago, based on the research that was done at the New York University by, I think, Tyrone Cordier, Subramanian, and Richard Roll, they said about 20 years ago or thereabouts, using data from the 1990s, the process, when that happens on NIS, arbitrators come in and they try to take advantage, and while they're taking advantage, they push the price back in the right direction, and they help establish some form of equilibrium pricing, if you want to call it that. And that time, the process was taking about 60 minutes in many cases. And over time, it was decreasing. And right now, the process takes microseconds or even less.
Have you guys raised the issue of VWAP? Is that the correct way of saying it?
Yeah.
Volume?
Yeah.
Volume weighted average price?
Do you guys, in the audience, have you ever heard of this expression, the VWAP price?
Volume weighted average price.
The notion is that when you go to a brokerage firm and you want to do a trade, you don't do it at the price that you see. You buy it at the volume weighted average price for a period, which is generally a day, right?
I can give a little historical perspective on VWAP, and this will take less than a minute. So 20 years ago, you would get international orders, often from a small island off the coast of Asia, Japan, and they would sell big blocks of stock once a day, 200,000 shares of a stock, and they would get one price. And that one price was usually at a 3, 5, 7% discount from where that stock traded the rest of the day. So the stock could be trading all day at a price. That print would go on below the market, stock would go right back up and trade the rest of the day. So, of course, over time, the managers realized we're getting terrible prices. What's going on? The stock's trading at 70, I'm getting 68. It traded at 70 away from my trade the rest of the day. That's unacceptable. So let's break our 200,000 share print into two 100,000 share prints. And so now it was down 2% instead of down 5%. And then they said, well, how about if we cut it into, 100 different slices? And thus, VWAP was born as a way of getting an average price over the course of a day, right? And that then translated into into with various data feeds, where people, for the length of the order, it might be an hour, 2 hours, or all day, they would get a representative average price of where that stock was trading. So basically, if you're a seller and you sell it on the VWAP price, you've gotten the average price for that day, and similarly if you're buying it. So it's a way of not being misrepresented. Now, that's great for getting an average price, but you may or may not get a certain amount of volume done. So if you're, let's say, a buyer and you want to beat the VWAP and that's your goal, you can do that, but it depends on how much volume you want to trade any given day. So that's sort of the history of why it started, and then it became sort of a standard for, are you getting a fair price?